I don't think I really have a controversial opinion, but I think one thing that makes most people surprised is when they ask me how much emergency cash I have, I usually tell them 2 years and they'll be shocked. Like, why do you keep 2 years? I thought the rule of thumb is 6 to 12 months. But, I see value in that in a sense. You always have to find that number that is suitable for you. In terms of, like throughout crises, you're able to hold through. You have that holding power because in order to finish, we must first be able to finish the race, right? And same thing with compounding and growing your wealth. I don't want to be in a situation whereby, maybe some of my family members, get into medical emergency, need cash or something, and then the market is doing very badly at the same time. I don't want to be put in a position whereby I liquidate at rock bottom prices, which is why I hold quite a lot of emergency fund. In terms of investable cash, I'm usually fully invested, but the 2 years is strictly no matter how bad the market fall, I will never invest that amount of money, and I will always make sure that my insurance, so on and so forth, is taken care of. It is always from protecting the downside point of view. I really don't want to be put in a position whereby one day I need to touch my investment just because I never handle my personal finances correctly.
Now, inside it, we share with you the tips and tricks to bring your stock investing skills to the next level. The best part, it's only 10 pages long and it's totally free. Whether you're on Spotify or YouTube, the link to download is in the description, or you can go to www.firl.co/free or www.firl.co/free.
Hello, everyone. Welcome back to the FIRL podcast, best place for long-term stock investors. Today's special guest is Mr. Thomas Chua. He is, in my eyes at least, huge on Twitter, one of the better writers out there, and there are many good writers on Twitter. And he has a lot of wisdom to share to everybody through his experience. Now, without me telling you listeners what he has done and and how he came to be, I will let him tell his story. But before that, welcome to the podcast, Mr. Thomas.
Thank you. Thanks for having me. Yeah, so I started investing about 14 years ago. I think that was when I was around 17 or 18. Right. What really got me started, right, was when I read the book Rich Dad Poor Dad by Robert Kiyosaki. So that book gave me the first aha moment, right? It was a great why book, but not a great how book. Like it gave me a very strong why as to like why I need to start accumulating income productive assets. Why there's this sense of urgency? Because ultimately it introduced a very real concept, which is called the rat race, right? And back then I was already half working, half studying, trying to pay bills and all that. So I could see very clearly, like if I don't begin learning how to invest today, learning how so-called the rich dad do it, then I'm just going to live my life, running the rat race. And, it seems kind of like a pretty unfulfilling and very sad life if I just, I live just to pay bills. And since then, I really started trying to learn everything I can about investing, right? And it wasn't easy. Like back then, the materials online, all this, it wasn't that sufficient. So I spent most of my time in the library. I remember reading all investing books I could get my hands on. Yeah, so it's only after a few years, I tried technical analysis, I tried, dividend, I tried deep value. Eventually, then I arrived at where I am today, whereby I mainly focus on companies, that have a wide moat, still expanding the moat. Maybe we can touch on this later. Yeah. Like the trajectory of the moat is way more important than the size of the moat today. And also company that's able to continue to grow, defend itself against other competitors, able to grow into different verticals, really compound investors' wealth over the super long run. Yeah, so basically that's my story from last time until today, how my investing style gradually evolved.
But before that, right, maybe as a kid, right, what were some of the money beliefs you grew up in? Because one thing I realized is that, I thought everyone had the beliefs that I had, important to save money, important to, give back, things like that. But apparently that's not necessarily the case for everybody. So I just want to get a sense, right? How were you raised and what were the money beliefs before Rich Dad Poor Dad, I guess?
Yeah, so that is a good question, right? So basically for myself, I come from a household where both my parents did not work since I was a very young age. I mean, for several reasons. Like my mom has always been a housewife. My dad, he used to be addicted to gambling and alcohol and so on and so forth. So, which is why I had to start work very, very early.
I see.
Yeah. So I mean, when I look at my parents, right, one of them like to save a lot. The other, don't have $20 even if his bank account at any one point in time. And it was very clear to me that saving money, being thrifty is super important. But then again, when I look at my mom and when I look at my relatives, those people who are very thrifty, but not high income earners or, don't even have a job at all, there wasn't a clear path to wealth or freedom in that sense. And when I look at that, it wasn't really the kind of lifestyle I want to have. And there was only two ways back at that age whereby I see, one could attain wealth. And then one is by starting a business. Or two is that you get a job and then you underspend your income and then continuously you invest that difference into the stock market or property or whatever you like. But it just happens that, I developed a very, very strong interest in the stock market. And I believe, at least in the Singapore context, that not investing in Singapore stock market, of course, but investing in overseas equities, you are going to compound your wealth at a much faster clip than if you were to invest in other forms of assets. Yeah, so long time ago, that was typically my money mindset. And I realized my parents, or my father at least, he had a mindset whereby he had a very different mindset from my mom in a sense whereby he don't believe in saving. We are all going to die one day. Why save? And rich people are usually snobbish, they call it haolian, right? I guess our listeners will get used to this thing. They call it haolian.
Yes.
Most of them know, for sure.
Exactly right. So I disagree very violently with those mindsets. And so when it comes to learning about money, it was really from reading books, not really an adult to consult with, but I guess, because in Singapore, there's a lot of libraries around. So I managed to get my hands on a lot of helpful books, which, helped lay the foundation for my thoughts about how I should think about money.
So as you, I'll ask then, John, you can proceed with yours later on. I have to ask, right, because I know John tells me this as well, in terms of trying to change and trying to, some people call it dramatically break the generational curse, but when you start to read books and when you start to change the mindset, once you start to disagree violently, as in your words, right? What was the reaction like from your family? I'm not sure if you have siblings or not, but just your family in general, and also maybe some of your friends, right? Because I know for some people, it's not an easy process to kind of take the other direction.
Yeah, so very good point touched on there. So there's a saying, right? When you are trying to change or evolve, don't tell anyone. Just go and do it first. After when they see the results, then they will see the benefits of it. Because when you try to be different, or when you are when you are taking actions that's slightly different from the herd, usually people will want you to pull you back to where you were in the past. So I mean, generally, when I first started investing, the standard advice was that it is gambling. Speculation is very risky. But the other thing, when I was transforming myself, apart from starting to invest, save and invest, was when I got scholarship to study in universities, pay for my education and all that. There was one thing that, my dad said to me that I will never forget. He told me why you even bother studying? Just go out and get a job. Studying is a waste of time, so on and so forth.
Wow.
And this was when I got offers from NUS, NTU, SMU, and I got scholarships
all three.
From all three. And then I got scholarships lined up. I don't have to pay a single cent, and they'll pay me just to study, so on and so forth. But that was the advice, right? Because I guess it was really doing something very different from what he was doing or what the people around him was doing. So I mean, even until today, whatever I'm doing, he will still disagree violently with what I'm trying to do. I mean, simply because it is different, right? And I don't know, it might be just because, he's uncomfortable with different or stuff like that. Yeah, but I guess it is what it is. If you really want to change your life, or like what you said, break the generational curse, sometimes, even your relatives or parents, might not be the best person to do it. You want to surround yourself with people who you are trying to be like, when you're with a group of like-minded people, I guess that is where, it really reduces the friction, and they will introduce you to opportunities, resources, the knowledge, the know-how, so on and so forth.
Right. John?
Yeah, that was actually leading a good lead up to my question, because I'm pretty sure most people find comfort in trying to anchor around advice or opinions from their family members. And obviously in your case, it wasn't the case. Did you actually had to migrate your friends? And I think you get what I mean, right? I mean, like, I tell MJ this every time I go back to a class reunion. We talk about the little stuff lah. But obviously, once your horizon has changed and your paradigm has changed in your case, did you actually notice a change in the friends and the circle of people around you? And how do you connect with them actually?
Yeah, so this is going to make me sound like an asshole, right? Okay, so when I was in when I was in secondary school, I basically come from the last class of my secondary school. So I mean, in Singapore, right? So basically, most of my classmates don't really have the mindset of wanting to change their life for the better, and it is not their fault, right? Because most of us in the neighborhood, not saying that we have dangerous neighborhood, but basically, when it comes to learning, right, most of us learn from our parents, and when we don't have that social capital, people will teach us how to act in social situations, or what kind of aspirations should you have in life. And the first layer is always you learn from people who are closest to you, and so most of my classmates are like me. The problem is most did not have the hunger to try and, or even dare to try and think out of that situation. I think out of my whole class, I probably myself, or maybe just one more person, made it to university in Singapore. Not saying that it is a must to make it to university in Singapore, but it is the kind of priorities we have at that age. So I'm a very firm believer of surrounding yourself with the 5 best people you are trying to achieve, and so I filter aggressively. When I look at people who go to class reunions, I'm actually quite jealous, right? Right, because I basically just cut off all of that relationship early on, and I really try to reach out to people who had a strong drive in life early on. Not that I wanted to be an asshole, but I think the probability of you being able to succeed when you come from a shittier family, right, is that you have to be very conscious and aware with who you are trying to surround yourself with. Not just because they may bring you more opportunities, but also I think the mindset is going to be very, very, very different.
Yes, so true. And I think looking back at all this, right, do you find friends or even family members that wanted to grow but were actually stopped because of the obstacles similar to you, in a sense that, like I'm pretty sure your dad will say something like "Si gina, that kind of thing, right? Normal Hokkien will Teochew will say that, right? But have you seen people in the same light as you, and then they couldn't break through that struggle? And what would your advice be for them? Because I'm very sure many people are in the same path as you. And what kept you going? What was your anchor in a way?
I think there's definitely other people who are trying to break out of that cycle as well. I definitely have a few friends in my class back then, but I would think I was lucky in a sense whereby I read a book. I can't remember what the name is that it is not just enough to always try new things, have grit, continue, but you also must know when to pivot, right? But I think for a lot of people, when they set their eyes maybe on wanting to go to junior college or they want to go to a certain polytechnic, so on and so forth. And that is just when their goal ends. But, I think in life, there's a lot of times whereby, once you reach that, then maybe that goal is not the best for you, right? Then that's where you have to make your pivot. I think especially the strategy I used when I was younger, getting scholarships, so on and so forth, I think would be very different from what young people today could do, because today the internet is much more established. If there's one advice I would give young people who's trying to maybe break the generational cycle is not just to start investing, not just to start saving, but also to start creating content online. Simply because like when you are creating content online, you are going to draw towards you a circle of people who you probably will never have the chance of meeting if you just stay within your circle based on proximity. Will draw towards you a very high caliber or group of if you're interested in investing, the investors will find you, ideas flow will come, and then with the traffic, which I'm sure you guys understand also, with traffic there's a lot of bargaining power, a lot of other opportunities, a lot of optionalities that will come up in life.
Yeah, so true. Yeah. Great insight. MJ, back to you.
It is. Actually, we'll get into a bit of your story when it comes to Twitter, but I'll leave that to the end. And I want to go a little bit into your uni days, because I did come across an article that you wrote, which was business school worth it? So I deliberately not read it so that I can hear from you.
Yeah.
I thought that was a very, very interesting question for me to ask, because there's a misconception that people have, where you work with what you study, and what you study will help you in work. And so I want to get your thoughts on, was business school worth it, essentially, because I assume you went through business school, and of course you're a high achiever, and maybe you can just let us know.
Yeah, so when I wanted to learn investing, right, the first thought that came into my mind was that I need to major in finance. But the truth is, so there are professions whereby getting the specific degree is going to be very important, like doctors, engineers, so on and so forth. But I think to learn investing, or in my case, I really wanted to become a great investor, is I believe you don't have to go to a business school just to do that, because mainly they're just going to teach you a bunch of theories, which is nice to know, but it is totally not important for you to know in order to learn how to invest. If I were to be able to structure a university program just for finance or investing, I would fill it up with examples, case studies, why this company, why it shows operating leverage, why it became a multi-bagger. But the truth is, I think other than maybe a handful of schools in America or maybe India, those really led by value investors community, those very, very renowned professors, most of them will not be able to give you the kind of education you are looking for. So, when it comes to investing, I find reading books or even attending courses out there a bit more helpful than attending business school. Business school, I guess it's not without merit. It helps you and establish a network, I guess. Like your friends will go on to, working in some remarkable companies, and then you will maintain that network. But beyond that, in terms of the technical topics that we study, I don't find it to be particularly helpful. So in that article, if I could redo it again, I would probably still do business school, because I have no idea what else I can do. But I would pay a lot less attention to getting the best grades. But I would pay more attention to creating content online, because I think the internet is really the ultimate leverage. Not just in this day and age. If I had a vision, I probably would have started 10 years back, because 10 years back, the internet was already a huge thing. And, really anyone can start creating content just because of how low cost it is. It's just a matter of whether you're able to overcome that friction in terms of, putting yourself out there, putting your ideas out there and getting judged by other people. Yeah.
So I guess now my question would be, what were the books that you read that up to this day is very relevant and it has shaped your investment style?
Shape my investment style. There's a few, I guess. I think the 100 Baggers is a good one. It helps you learn how to identify companies that are able to keep reinvesting at very high clip.
This is by Chris Meyer, right? This is the book by Chris Meyer. Is that right?
Yes, that is right. That's the author name. Then there's another one called The Outsiders, which helps you learn about management who's able to deliver that outstanding returns for you. Then there's also Capital Cycle, which is basically a accumulation of Marathon Asset Management letters from 2002 to 2015. So that is a very good book to learn about market cycles. And the author was very, very amazing at sharing how he transitioned, from a cyclical investor to eventually he just want to hold quality over time. Warren Buffett letters are must read. Then there's also Nick Sleep from Nomad Capital. His letters are also a must read. Really, really very good letters. Then maybe one last one is Howard Marks. Really just to understand market psychology, right? How the pendulums swing from extreme pessimism to extreme optimism.
So how about that book on Marathon Asset? Because I think of all the books you mentioned, that's probably the one where I've not read. Maybe if you can just share with us a little bit deeper of some of your big takeaways from that book.
Right. So their investing style is, if I have to put it across in a very simple, or very summarized way, is 50% invest in cyclical companies, another 50% invest in the quality compounders, which is basically how Nick Sleep does it. Fun fact, Nick Sleep is actually a student of Marathon Asset Management before he started Nomad. And then when it comes to the cyclical investing, there's a lot of hints of how Howard Marks do it. The extreme pessimism and extreme optimism. And there was one very helpful tip given by that book when it comes to investing in cyclical companies. Basically, it's a lot of people will try and forecast demand. But demand is very, very difficult to forecast. What you should focus on actually is you should focus on the supply forecast, because supply don't change so much from year to year. So when it comes to investing in cyclical stocks, you really want to keep an eye on the supply that's coming out. So maybe for example, investing in Singapore, maybe property counters, right? It's actually relative easy to know what's the supply is coming out, because the government is always publishing over the next few years how much land they're releasing. The HDB will be publishing how many units are coming out. So you actually have a rough idea of what the supply is coming on when it comes to investing in property here in Singapore. I'm not sure in Malaysia whether they have that, but they probably do publish like a roadmap, like the next few years, how much land bank is coming out, So if you are investing in, cyclical industries like this, then you really want to focus on areas, the supply aspect of the analysis.
That's a great point. And probably I want to peel a little bit deeper and applying it towards different industries that exist today. Do you think that concept or theory is applicable to disruptors in a cyclical industry? For example, if we look at the shale oil revolution that actually capitalized a lot of what I would call trapped assets or undervalued assets of oil in the US, right? I don't think anyone within the oil industry foresaw that shale oil revolution or that boom. And that was actually an excess of supply that made America to be the number one exporter today as it is today. So how do you think that applies? And will we be able to spot some kind of a disruption to cyclical industries, in a way?
So one area the book touched on, but I must first clarify that I generally don't invest in cyclical stocks. But one tip the book actually gave is that you want to monitor how much investments is going into the industry, because there was a very interesting study done by the author. The returns of investment is actually negatively correlated with how much investments is actually going into that industry. So when there's a lot of money chasing after oil in US, you can actually expect returns to start declining over time. And that is just how the cycle works, right? Whenever there's a new thing coming up, money will all chase after that. And, returns will start going down until, people are afraid, people are worried, people start pulling their money out. That's where alpha could be generated after. I guess if you want to forecast, the leading indicator is how much money is really going into that specific industry that year. If it's a huge jump from previous year, it's going to be quite an accurate leading indicator that, returns for that specific industry is going to start declining over the next few years.
And that all ties into the supply analysis, right, that you're talking about.
Exactly.
Right,
it's good because we've already seen it, especially for renewable energy. We talk to a lot of companies in the space, and the IRR returns for most of these businesses are abysmal.
Right.
And here I want to add in maybe a cheeky question. ESG.
Right.
And I'm pretty sure you know where I'm heading with this, because a lot of money is being poured into ESG. And yet the rules of engagement for ESG is very much, I don't know whether you agree with me, are very much vague. What is ESG? Because today there is no metrics or like an index, like the S&P 500, there's an index, there's a very clear rules of engagement, whereas ESG is like, we haven't even got the carbon credit scoring proper. We haven't even got the social governance proper. So I don't know whether you can measure diminishing returns for ESG because it's so broad-based, but what are your thoughts about it? Because
did it have returns in the first place, right, John?
Yeah.
Exactly.
Thomas.
So, the good thing is I don't have an employer, right? I can say anything I want. And I echo what Warren Buffett and Terry Smith, they always say about ESG. It is just a gigantic marketing tool. And, there will always be capital that will only want to invest in ESG, which is why they're using it as a branding to attract capital. But like what Terry Smith said in his latest annual shareholder gathering, right? And the truth is a lot of these companies are not going to bring a lot of returns for shareholders. Ultimately, when it comes to investing, right, it is still whether that company has a competitive advantage, whether they are able to grow their business. Just being environmentally friendly, so on and so forth is very important. Being socially responsible is important in the long run. But we cannot base our analysis just based on ESG alone. The number one, number two filter, ESG is probably maybe several layers down the filter. We always have to look at the competitiveness of that company first.
Yeah. I love those insights.
I think you were very kind to say that it's lower down. I think that's the kind version. Just surprised it got onto your list or so.
Sorry to interrupt this podcast. I know it's a little bit annoying, but I want to tell you something that I think can be really helpful to you. I can tell you're really interested in the stock market and want to learn more about it so that you actually know what you're doing, especially when today things are getting more complex and complicated. That's why we came up with the Stock Investing Blueprint, or SIB. It's our signature e-learning program that teaches you how to pick the right stocks most of the time, buy and sell it at the best possible time, and manage your stock portfolio systematically. It currently has more than 10 hours of content and it's growing. You'll also be part of a group of like-minded investors that can help speed up your learning process. To hop on the program, click on the link in the description or go to learn.firl.co/courses/SIB.
Anyway, so you mentioned that there's this split for marathon of half, right? And you said that you don't really touch cyclicals and you're more of a long-term compounder kind of guy.
Yeah.
Maybe you can share with us why that is the case. One, two, what is your idea of a long-term compounder? What are the characteristics?
I think number one is because there is so many companies out there to focus on, and if I really want to compound my knowledge in that specific industry, so on and so forth, it is not an industry or company I want to jump in and out of. I want to really know that company. I want to grow that knowledge with the company because knowledge compounds as well. And jumping in and out of a company is probably not my game. It might be the right thing to do for some people. They may be just remarkable at investing in cyclical industry, but I recognize that is probably not where my circle of competence is. But what I like to do is I like to a typical compounder, their traits is number one, they have a very strong competitive advantage, which is still growing. Still growing is very important because the trajectory of their competitiveness is very important. Or other words, in their modes, right? their defensive mode is very important, because otherwise, at one point in time, we would have chosen Nokia over Apple, or Blockbuster over Netflix, or even some other company over Facebook, right? Because at one point in time, those are the younger companies. Their moat is smaller, their competitive advantage is weaker, but the trajectory at which they are growing, their competitiveness is very extremely rapid. So when it comes to investing in compounders, we want to see that trajectory going in the right direction, for the reason that, if we are out there to hold the company for the long run and for them to keep reinvesting money on behalf of us, we want to make sure that their durability is there. And then the next thing we want to see is that they are going after a large market, right? Riding on a very strong circular tailwind. Again, because when we are investing in a company, we are passing our money, our capital to the management to reinvest on behalf of us. So sitting on the tailwind definitely helps if they're able to keep reinvesting for many years. That's how compounding actually takes place. And 3, we really want to look at management who have our interests at heart. Are they just looking to build an empire? When they're investing, they're not really looking at how much returns this is bringing for shareholders. So when these 3 things align, then I think we have a very nice so-called compounder that we find. And when I find these, I just want to buy them and monitor them. Not so much. I guess there's a lot of people who they are very proud when buy and hold forever. But I would say buy and monitor, right? If the thesis change, then we got to change our mind.
Right. So competitive advantage is a very big word, and of course, I think when people Google that term, they will find all sorts of versions or types of competitive advantage. What would you say? I'm not going to ask you to name all of them, obviously, but what would you say are some of the advantages that you favor? Because not all of them are created equal, let's say.
Yeah. So there's 2 favorite of mine, and there's a good reason why I really favor them, is because they actually grow with scale. So, I'm sure you guys read the letter by Nick Sleep. So one is scaled economic share, right?
Yeah.
Whereby as you grow, your margins increase, your profitability increase, but you don't take all the money off the table. You actually give them back to your customers.
Yeah.
So when you reward your customers in turn will reward you with more sales. Yeah. So as you grow, your operations become way better than the next competitor, but yet you pass it back to the customer. And so as you grow, you become stronger over time. Yeah, but it's very important because over time, usually the case for most companies is as they grow, they become weaker, right? They're not as nimble, they don't move as fast, they become complacent. But for companies like Costco or even Amazon, that if there's one thing customers will forever love, it is low prices. Yeah. And so, as they grow, we don't need to be worried that they'll be displaced, because their key value proposition is the value, low prices. And just by growing alone, they will be able to sustain their competitive advantage. And so that's just a very beautiful mode, right? Very beautiful competitive advantage. Because when it comes to investing, especially when we are looking for compounders, durability is the most important thing. We want them to have enduring success. So that is one of my favorite. Then the other of my favorite one is network effect, which is just, every time there's a new user coming in, it actually makes the network stronger. The classic example for this is Facebook, Instagram, or even YouTube. Whenever there's a new user or new content creator that come in, the platform just becomes better as a result. And there's always a critical mass that this platform have to hit. And once they hit, right, it's just very, very difficult to disrupt them. And just like all content creators, if we have a podcast or we have anything, we must be on YouTube, because that's just where the traffic.
Oh, yeah.
And I wouldn't say they're doing it for free, because they do revenue split. But for companies like Facebook, all this, they don't do revenue split, and yet all the content creators will want to go onto that platform. Or even for Twitter, I will have to go onto that platform if I want to get any form of attention. So anytime the company grows, it actually becomes stronger and stronger over time. So these 2 are my favorite, network effect and the scale economic share, because as the company grows, they actually become stronger over time. And it's very important for me, because I place a lot of emphasis on the durability of a company.
Yeah, actually, when you mentioned about the Amazon effect, right? Pat Dorsey actually did this experiment, Thomas, I don't know if you're aware. He was giving a talk at Google, and he actually asked everyone in the room, once you want to buy something, right, and you found it on Amazon, how many of you actually go to another website to compare?
Yeah.
You want to take a guess what was the number?
I would think maybe 5% or something.
It was less. It was less, 5% or less.
Maybe less, right?
Yeah, so it's like the moment you found it on Amazon, right? You're very unlikely to go and find another because you know that they are already at their price point is probably the best for you already. Actually.
Yeah, what I found Nick Sleep's points to be really good is this idea that you give back to your customers, and actually they don't really care essentially about what analysts think, right? Because the analysts would be saying, "What, you have not changed the prices of your hot dog for 26 years, right? And it's like razor thin margins, like where's the breathing space and all that." But he was just replowing everything back, keeping everything the same. And that gave him a lot of bargaining power with suppliers, etc., etc. For those of you who are listening, go check out Nick Sleep's letters. It's probably up there with Buffett's ones. It's one of the best. But now I want to go into so you've learned all these things, and you found them so useful, and obviously you've started applying them into your own investments. What would you say so far is your best and your worst investment? And maybe explain why they were your best and why they were your worst.
I think my best investment is probably Google and Amazon over the past maybe 5 to 10 years. I mean, they are the best because, and it is very, okay, I wouldn't say it's easy because I'm going to get a lot of hate for that. I mean, when we think about their products, right, like Google, how can anyone not live without Google, right? When we think of that kind of services, the search, the Google Maps, or even YouTube, right? It is very hard to imagine a world whereby, you don't have Gmail, so on and so forth. So there will always be a lot of bad news from time to time. I mean, because that's just what mainstream media does, right? To get attention, everything must be pessimistic. Everything must be breaking, in order to get your attention. And when investing in companies like that's very well within my circle of competence, and the metrics is clear as day for me to track, customer satisfaction for Amazon is always going up. More and more people are coming onto the platform. They are onboarding more and more Prime members, so on and so forth. It is very easy for me to hold through this company through, a lot of volatility. If I talk about my worst investment till date, it's probably Alibaba, but I don't believe that it is a wrong investment choice. Because there's this book by Annie Duke, which is Thinking in Bets, right?
Yeah. Oh yeah, I love that book.
That book was another aha moment for me. Like when it comes to investing, it is like playing in poker. The results could be bad, but your process, might be correct. Or the results is good, but your process might have been wrong, because there's always the element of luck there. And when investing, it is always about probability. So Alibaba, I think everybody would know it is due to the government regulations, so on and so forth. But I don't think the government is out there to crush them like what a lot of mainstream media is saying. Like they call it common prosperity, donation, and so on and so forth. But I disagree quite heavily with that, and I'm quite willing to hold Alibaba true. So basically these two, or rather three companies two of them would be my best investment. Yeah. Then Alibaba probably till date is probably my the one that gave me more horrible results.
So but I think it's the time horizon. Sorry, it's just probably the time horizon in which we are recording this. That's why it looks bad,
Maybe I asked the question about your worst investment. What is the worst investment that you've realized? I guess because as you rightly point out, right, Alibaba. I mean, the story is still unfolding. Right, nothing is settled yet.
Today, China just released the rules for regulatory listing, so it's already a step in the right direction.
But of course, on Twitter, it's settled, right? Because if you lose 20%, you're automatically wrong already, right? So, which is an investment that you use Annie Duke's example just now of good process, bad results. So that seems to be Alibaba's story for you right now. But perhaps share one story where wrong process, bad results, and maybe even wrong process, right results,
I mean, if I were to think about wrong process, right results, it's definitely got to do with dividend investing. Because, so out of 14 years of investing, I think for the first maybe 6 years, 5 to 6 years, I was just investing in dividend stocks, basically company that cannot grow. Because I mean, they're putting out all their cash to shareholders, right? So I mean, there's heavy opportunity cost there. I mean, of course, back then I was very happy, right? Every year I get 5 to 6%, so on and so forth. So I mean, that was I would call that lousy results, because I mean, if you were to think of opportunity cost, I could have done so much more, grow my wealth so much more. But because that feedback didn't hit me much early on, and I think one that I probably lost a bit of money on is I think it's called First Read, if I never remember wrongly. They hold a bunch of property in Indonesia, hospitals in Indonesia. So, and you know, the currency depreciation back then really hit the company quite badly. Yeah, so for the longest time, for most of my portfolio, which was just focused on dividends, right? The process that was wrong is that I should have focused on total shareholder returns. I don't want to shit on dividend companies, but it is not wrong, but we have to focus on total shareholder returns, which encompasses your capital returns and your dividend returns. And we always have to think in terms of opportunity cost. Like if you're looking at this set of companies, what is the opportunity cost that you're incurring as a result? Yeah, so nothing wrong with looking at dividend counters, but you know, we always must take everything into account. You must take total shareholder returns into account, not just your dividend yield.
Yeah, I want to segue a little bit into probably the reasoning for why you started off dividend investing. Was it because of your risk appetite or your circle of competence that you felt that when you started off investing into dividend, it was a much safer bet, for the lack of a better word? Was that the reason?
I think it was just the what was trendy back then. You know, all these super popular bloggers, or you know, they were all always talking about dividends. And so when I surround my information intake with, you know, influencers who are always talking about dividends, and then naturally I gravitated towards that. It wasn't until YouTube became more popular, so on and so forth. Then, you know, I got exposed to other styles of thinking. And the aha moment was, I can't remember who was the one who said it, but we must always think in terms of total shareholder returns. If we just look at one metric, then it is just myopic, right? We are going to miss out a lot of stuff. And the truth is, a lot of dividend paying company, if the yield is 5% or more, it's probably because they got no more opportunities for them to invest. They are probably at the tail end of the S curve and almost going down, which is why they have so much money to give out, and which is why the market is not putting a very high price. Hence, we are able to get that 5 to 6%. I mean, if it is a very strong company that, you know, that they are able to give out dividends just because when they grow, they don't need capital, like your MasterCard and Visa, they're going to be priced extremely expensive. They are dividend paying companies, but the dividend is probably like 1%. And that is just a fact of life. If we are looking at companies that are paying like heavy dividends, it's just probably they are nearing the tail end of the S curve, and the market recognizes that, which is why the market don't put a very high price on those dividend counters.
Yeah. Just one last question before we move on, which is your understanding of risk. Since you mentioned that you got into dividend investing more because it was popular, but has your definition of risk actually change and evolve throughout your investing style? Because one of your Twitters actually said that risk is not volatility. And actually, MJ and I, we get a lot of big bets because we say that no, risk is actually not volatility.
So what from the robo-advisor crowd.
Robo-advisor crowd, which, you know, and it's taught in finance, you know, risk is volatility, you know. So I really want to hear your thoughts on it, Thomas.
Yeah, I mean, risk is definitely not volatility. Volatility is opportunity. I mean, at least that is what I think, right? So, I mean, risk is always, we have to go back to the fundamentals of the company. Access, you know, how likely this company is going to be around 10 years, 5 years, 10 years from today, you know, and why do they deserve to be a bigger company than today? And so when we are assessing risk, we are trying to stress test whether this company can withstand against competition, whether this company, you know, in case of a crisis like COVID causing everything to shut down, are they able to survive without cash inflow coming for the next few years? So that is risk. We have to think like business owners. When we are talking about price movements, it is really just the stock market as an auction market, right? People are bidding prices up and down every single day. And I mean, you wouldn't go to the auction market and every time the price move up and down, then you call that risk. It is not risk, right? It is just, I don't know, maybe human psychology taking place. And it is really a feature, not a bug, right? That the prices are supposed to move up and down every single day. I mean, so definitely that is not risk. I mean, I'm not sure whether it is the robo advisors that's preaching that, but I mean, when I say that on Twitter, I do get one or two comments like, how could you say that volatility is not risk? Then what is risk? Like market moving up and down it happen every single day. I mean, every year the market will definitely have some drop. If you just look at the 52-week high and low for even the biggest company, your Apple, Microsoft, and I mean the difference is usually about 40%. But
Correct.
Has the business fundamental changed 40%? Probably not. Yeah. It is really just the emotions swinging, and it is usually temporary in nature. So risk comes from not knowing what you're owning, comes from not understanding the fundamentals, or it comes from, maybe the business is anti-fragile, but it definitely does not come from share price movement.
Yeah, I think I like Lilu's quote best. Risk is permanent loss of capital.
Exactly.
Simple and sweet.
Yeah.
Yeah.
It's actually not easy for people to tell because I think people are also not thinking in bets, right? Like they cannot imagine that, hey, that sort of upside, downside kind of thinking where, yeah, I could lose everything, but I could also make, multiples more. And I think that's very difficult for a lot of people to think. But that's just my point of view. One thing I want to get into is, I mean, you talk a lot about your past, right? But how about, looking forward now in terms of what outside the three that you mentioned, right? Or unless maybe you still feel that they are great, your best ideas right now. What would you say are some of your best ideas in terms of right now, like going forward, that stocks that you think have a really great potential and then fit into that 3-step criteria that you talk about of, trajectory of mode, size of the opportunity, and of course, great management?
Yeah, so I am generally not a macro investor, right? But there's a lot of talk by my friends in VC, so on and so forth, that the capital market, they are not handing out money freely like last time. So if I am looking for opportunities today, I want to look at companies that are not reliant or at the mercy of the capital market. Again, this goes back to the concept of risk, right? You don't want the company to be fragile. You want it to be anti-fragile.
That's right.
And so like a few opportunities that I look at recently is probably, one of them is Netflix, because they recently missed analyst estimates, right, in terms of their future forecasts, because of the COVID impact. But here's how I see it. There is currently still about 800 to 900 million in terms of paid cable TV, users out there. And Netflix really only have 200 million users. The runway is still long, but because of the COVID pull forward effect, the most recent quarter, they're not able to hit the numbers. But when we look at Netflix in terms of their subscriber growth, we really must look at it in 2 years block. We cannot look at it on a year-on-year basis, because there's this very strong pull forward impact. Yeah, and so management has been very clear that they expect operating margins to actually increase 3% yearly over time, not in a straight line, of course, because they are going to reinvest heavily into creating new content. But I do think that Netflix is going to maintain its leadership in the streaming industry, because ultimately it goes back to a skill game, right? Whoever is able to put out the best content out there, divide the cost over the most amount of subscribers, then they are going to be able to protect their position over time. And this was really one change in my thinking also. I used to avoid companies that consumes a lot of capital. But then again, when you look at companies like Amazon and Netflix, right, it is exactly because they are quite capital intensive, but yet they are able to scale, right? They invest in one thing, they are able to scale it to, everybody around the world. So that is quite a different way of capital intensity as compared to maybe a shopping mall. When we look at a shopping mall, it is capital intensive, but they cannot provide their services to globally. It's just to their
very, very localized.
Exactly. So they can't scale. So when it comes to capital intensity, there's also a difference between once you put in that capital, are you able to scale to an unlimited, so-called unlimited amount of customers? And Netflix has that. And when you look at the amount of award they have been getting, right, for their shows, it is not an easy feat. most amount of Google searches, most amount of nominations, so on and so forth. Yeah, so I think that company probably is a bit misunderstood by the market today, just because they miss the near-term estimates, Wall Street estimate. And this is really where volatility, I think, is an opportunity. Again, this is not recommendation to buy or sell, but this is just me thinking out loud, right? Yeah, but basically, I do think that Netflix has a very, very smart management. Reed Hastings on helm also. Going into gaming, not sure whether that will be successful, but what needs to be done, you can be sure that Reed Hastings will definitely do it. You saw that, we saw that Netflix, become from a DVD rental company into streaming. And then, subsequently they started small in terms of financing their own television shows back in 2011. And when they recognized the threat that, one day all these traditional companies, if they want to go into streaming, they would definitely cut off their supply of shows. And that's when he really gassed the pedal, and really start going into even movie productions, right? We seldom see a production company doing both television and movie production at the same time, because they require very different skill set and different level of investment. But Netflix, just within a few years, with so little experience, they are able to do both quite successfully. And today, they're one of the biggest producers of shows and movies. Yeah, so I mean, he has a very strong track record of pivoting the company when it's required. And furthermore, they're really sitting on a circular tailwind. And, I think streaming is really the way to go. I mean, I can't imagine myself turning into Channel 8 MediaCorp channels, so on and so forth nowadays. It has to be streaming, because like, you watch whatever you want on demand, and it is just much more convenient at a lower price.
Yeah. Actually, I've got a few questions related to that, because obviously I miss Netflix. So I stab my heart every time I think about it, because I'm a big believer. Because I actually watched TiVo. In the past, TiVo was, in a way, would you agree? Yeah, it was a bit too ahead of its time, I guess, right?
Yes.
But here comes the competition today, because I have children, 2 kids, and I find myself more attracted to Disney Plus kind of content versus that of Netflix. So it's more catered to adults, obviously, but as a family content, I would look to Disney Plus. How do you see that competition? That's the first question. And second thing, Amazon Prime also has, started going into this, and I love the way they package it as, Prime service plus the movie and all that. Why do you think Amazon Prime is lacking to what, obviously Disney had a head start, then Netflix caught up and all that kind of thing. So first question is, what do you think of Disney Plus as a threat? And secondly, why do you think Amazon Prime, or even new guys coming into the streaming service, how would they break that barriers into entry into the streaming service?
I think you're absolutely right that this is a very competitive industry with, not just the smaller players coming in. Also, even big tech, Amazon, Apple TV is also coming in. I think Apple was the one who won the Oscars award for this year or something. Yeah, and I hear a lot of people call Disney Plus the cheap childcare. You alternate it on, then you can do your work, right? Then your kids
I love that.
Yeah, it's like a childcare, but much cheaper,
childcare on demand. Childcare
on demand. You don't need to check in with the babysitter whether you've got time, appointment, and all that. But you just turn it on, your kid will quite sit there, and just listen, right? But I guess it really boils back down to a lot of industry, I feel, can be disrupted, could potentially be disrupted by Amazon, Google, Apple, so on and so forth. But there's always a good reason why they haven't been so successful lately. It's just because that is not the focus of their game. Like when you look at companies like Afterpay, why weren't they disrupted by MasterCard or Visa? It's just the focus of the management is not there. Whereas for Netflix, right, it is really their bread and butter. And when we look at the specific metrics in terms of how much customers churn, they actually have the lowest in the entire industry. I think it's 2 to 3%, whereas I think Disney is high single-digit percentage. And then for the rest of them, like Phoenix, so on and so forth, it is double-digit. So they don't have that stickiness to their platform. And for a lot of people, if you don't have Netflix, a lot of your friends the Americans, your friends will be talking about this specific show that came up. And then, generally people, we are social beings, right? And then we want to participate in that conversation. And that's where people will start, they want to own Netflix, hold on to have a Netflix subscription just to, catch their favorite shows and so on and so forth. And again, the Disney Plus, right, I mean, definitely they are a great service. I have 2 subscriptions. But I don't think it's whereby only one platform is able to survive. I think most of the time people will have maybe 2 or even 3 subscription. Simply because right now when we look at the cable TV cost in America, it is about $80 to $90 per month. But when we look at what Netflix and Disney Plus is charging now, it is just even if you hold to both of them, you are still saving a lot of money.
Correct.
Yeah, so I mean, they have very different style of production. Our Disney shows is actually quite usually quite different from what Netflix does. So I see most people having 2 sets of subscription rather than just one. And then competition-wise, it is really whether management will going to continue to invest in new content, so on and so forth, really grow the value proposition for users. And we are able to see that they are not just having the lowest churn, but they are also consistently raising prices every single year. But yet, most of their subscribers are not leaving the platform, which really demonstrate the stickiness, right? Because I believe that Netflix have been underpricing their service for many, many years. I mean, we get so much shows just for such a cheap subscription fee, right? And so with that, they have demonstrated that they are able to raise prices 5 to 10%, not 5 to 8% consistently every single year, and users are not falling off. Which is why, while it is a competitive industry, they have shown a track record of delivering sufficient value that their subscribers generally want to stay on as a user, and they are extremely subscriber friendly. I think it is a marketing move, but I think earlier this year or last year, they actually automatically unsubscribe you if you haven't used Netflix for 2 years, right? Which is just a very, very user-centric movement action. When we look at companies like New York Times or any of the, it could be Bloomberg, it could be Harvard Business Review. If you want to cancel your subscription, you can't do it online. You have to call the customer hotline, and the customer hotline will talk to you for 1 hour before you can cancel.
Create a lot of friction.
Exactly, a lot of friction. But customers hate that. And when we are looking to for companies to invest in, right, we want to look for companies that actually delight customers. And Netflix is very, very customer centric. So anybody who haven't logged into their account for 2 years, they automatically stop deducting your credit card and then just cancel your account for you. And then I think that really, if customers would definitely be happy. The trust would build for the company. The reason why I say it's a marketing stunt, because it's only like 0.1% of their subscriber base who don't log in for 2 years, but it generated a lot of
goodwill.
A lot of goodwill. Like the media will report, wow, this is a company that automatically unsubscribe users. It is not just about money. They're really thinking for the users. So that they have a very good branding, and the consumers love them. It is not like some companies whereby consumers hate them, but they have to use them. So this is a product whereby consumers are love them and are willing to put their money just for that entertainment that Netflix actually brings to them.
Yeah, thanks for your insight.
I only have one follow-up to that, which is when you look at Netflix, I mean, they're a juggernaut essentially, right? They essentially reinvest every dollar that they have into the company.
Right.
What other ways, apart from what they're already doing right now? Because my assumption is that yes, although there's still a long runway in terms of streaming, right? What other ways do you think they can create new business? So to give a sense, right? Of course, nothing is ever the same, but like what Disney did, right? Because essentially they are following somewhat the Disney route in that they always have to do high quality content. You need to own the content, the IP and all that. And what Disney has done over the past, since Walt Disney essentially, is to create horizontal businesses, right, that are linked to their brand. So when they come out with a really good movie, not Cinderella, let's say Mickey Mouse or whatever, then there's a theme park, right? Then maybe there's merchandise. Then there's all these other things that really, hook people in more. Because
ancillary businesses that are related to the theme. Yeah,
theme parks, whatever it is. Do you think Netflix should go down that path? And if not, what other areas can they really branch into?
I think that is a very good point, right? Because when it comes to Disney, when they create content, there's creating content is a capital intensive endeavor, but they're able to monetize through many other ways, selling their IP, franchise, the products, so on and so forth. And for companies like Costco, they sell oil, petrol cheap, they sell ice cream, hot dog bun cheap, but they earn through the membership. I think for Netflix, the most recent Morgan Stanley tech conference, the management actually came up to discuss advertisement. So for many years, they have been very against advertisement. But from the latest tech conference, they actually show signs of relaxing their stance on advertisement. And I suspect they are going to look at Disney Plus, because Disney Plus is actually quite keen on including advertisement for their paid users. So Disney Plus is likely going to have multiple tiers. One tier whereby, strictly just paying a subscription fee. So you pay more, but you don't see advertisement. Then there's going to be a cheaper tier whereby you see a bit of advertisement, but you pay a much lower fee. So I think the management has always been quite proactive in terms of doing A/B testing. And I think if Disney Plus is able to show some signs whereby, they are able to pull this off successfully, whereby they don't lose a lot of subscribers as a result of them putting advertisement on the Disney Plus homepage, then I think there may be a chance whereby Netflix may follow suit. And advertisement definitely is quite a big market, right? And I think there is also, the second thing is there is quite a lot of signs pointing towards Netflix having a lot of influence over demand for products in terms of outside streaming. So when we look at Witcher 3, right, once Witcher 3 got released on Netflix, the book sales went up. The game sales actually went up also.
Queen's Gambit.
Exactly.
Yeah.
There is this ripple effect to other products, right? And I think it is definitely an opportunity for management to further monetize their content. And I'm quite sure sooner or later they will. Furthermore, we are able to see them, their margins actually being quite decent now. So, I mean, with the COVID pull forward effect, right, pull in all the demand in one shot, their operating margins actually shot up to 20%, for that year alone. I mean, management say that they're going to reinvest more heavily with this money. But I mean, it gives us a very good glimpse at its steady state, right? What the profitability profile is going to be like for Netflix. And I think over time, it will become better and better, similar to Amazon.
Yeah, it makes a lot of sense, actually. Didn't think about the ad angle. Okay, I think the next part I want to go into is also something I found very interesting on your blog, which is the importance of an investing journal. And I think this probably ties into Twitter as well, maybe later on. But, investing journal is not talked a lot about in investing circles. Some people have it, some people do it, some people are put it on their phone, their physical notebooks. But what would you say is the importance of to you of an investing journal, and number two would be how do you do it? Is there a right way to do it?
I think for a lot of investors, like when we invest, putting down our thoughts in writing actually help us think better. And so one way I like to do my investing journal is it has to be something that's super brief, because when there's a lot of friction, most of us will not keep up with the habit. So I mean, I'll write out my short thesis and I'll do a quick pre-mortem. There's post-mortem, right? After dies, right? Try and investigate. But we always want to think about what are the potential riskiest outcome we can think of. And so that if something goes wrong and we go back to revisit our thesis, we are very clear about our thought process back then, what went wrong, and what do we have to change about our thinking of investments, so that going forward we can be better. Because I think for a lot of us, right, when we invest or when we do anything, if we don't write down our thoughts, usually we will forget like why we established that position in the first place. And also when the market is volatile, I mean, even after so many years of investing, it is still not easy to sit through volatility, even though, I understand the company well. So that's when I like to look back at my journal and, really think through why I invest in this company in the first place and what the potential it could be. So that helps me sit through this kind of volatility as well. Yeah, so it's really down to two things. One is, helping me become more aware of the risks I'm taking through writing down my thesis and the pre-mortem. And then the second thing is to, it becomes easier for me to evaluate if my investment don't go well, what went wrong with my thinking, because it is all there in black and white. I read a research before. I can't remember which author is it from, but humans really do have the inclination to forget our past decision-making process. So if we don't write it down, most of the time we won't be able to, remember what are exactly the specific details as to why we make that decision and what our processes are.
That's true. So would you consider like your Twitter something like a little bit like a journal, or do you think that's something that's totally different in objective?
A bit different, because when it comes to Twitter, right, I have to refine it quite a fair bit. So there's a bit of friction there. I do put my thesis out there, whenever I want people to come and criticize. I need devil advocates, because I rather people come and criticize before the Mr. Market come and criticize me.
Yeah.
That's where real money is lost, right? But my journal is really super low friction. It's really like a few lines. I don't try and beautify the words, so on and so forth. But when it comes to Twitter, I have to make sure it flows nicely for my readers. So in a way, I still write my thesis, so on and so forth. But my journal is super messy and so on and so forth. Yeah, it really must reduce friction in order to inculcate that habit.
I see. Just a little bit peeling into your journal and all that kind of thing.
Right.
What has been the weirdest place that you've gotten a stock idea and then you start thinking, then the light bulb start going up, and then where do you think have you experienced that someone was so bullish about it, but immediately or quite spontaneously, because of the mental models you've developed in the past, that you say, this is a horrible idea, Probably can you give us an example because of the way you write your journal and then...
Sorry, I'm just trying to think. So a company that's overhyped by the market.
Yeah. Like 90% of people, hey, Thomas is a good one. Here's my thesis, whatever. And then you said, I just journal a few steps and then, hey, no.
Wow, this is going to offend a lot of people. Definitely cannot talk about car companies. No. Let me think. Okay. I guess back then it's probably Grab. I guess when Grab first IPO'd, there was a lot of hype. But even when we think about tech companies, it is always about becoming a platform, generating that flywheel effect, so on and so forth. So a lot of my readers actually ask me about Grab when it IPO. Is it going to be a good investment or not, right? But when we look at companies like Grab, Uber, or even Lyft, right, it is not enough to onboard a lot of active users every month. We must also look at how sticky the platform is. And the truth is, for a company with this kind of business model, users are free to go whenever they want. And really, ultimately, the competitiveness of that platform is who can offer the cheapest price. And, you are going to be in a struggle between the customer, yourself, your shareholders, and also the regulators. Because when you increase the take rate too much, which is essentially the commission, the regulators will come after your ass, because ultimately the regulators, they want to be voted in, so on and so forth. They have to look out for the small businesses and also the users. And so it's really not a very good investment, even though there was a lot of hype, because Grab is a company everybody uses. But when I just look at the stickiness of that platform, if I were to just do a pre-mortem why this platform, there's something wrong with this platform. We call this the leaky bucket problem. Like, you put in a lot of money, but there's always a lot of holes in that bucket, and all your investment will just leak away when your users have so much other choices out there. You may say that it is the biggest one. There's flywheel effect. More people come in, then the merchant riders all want to come on in. Also, it's true, but then again, you don't really have a very strong pricing power there. People will just leave the platform.
Yeah, where has been like an idea that you thought that this probably didn't work. It was so unpopular, but because of your journaling and the framework they've developed, they say, hey, it may not look so bad, because I'm trying to like highlight potential examples where journaling actually helps aid people with biases, which we all have, Right. And unless you have a framework and you put it down, then it becomes clearer, because most of the time we are clouded by a lot of these news headlines and all that. So was there an idea where it was not very sexy, not very appealing, but because you journaled it and then boom, it looks attractive?
Yeah, so I mean, if I were to talk about one mistake whereby if I were to revisit my journal, I mean, it would have to be Tesla, right? I mean, for many, many years, I thought Tesla would not make it. But the truth is at scale, right now they are actually operating profit, or rather they're actually profitable already. They're free cash flow generative. They don't have to rely on outside capital already. I guess that is one example whereby, after my journaling, sometimes it is really you have to try and envision a future. But for Tesla, I mean, I have to admit it is very, very difficult for me because, I mean, probably it's outside my circle of competence, so on and so forth. But, that is really one big miss. And, everybody is saying like it's going to be bankrupt, so on and so forth, but somehow they made it. So that is definitely one good example whereby, if I were to revisit my thought process, what went wrong? I mean, it is probably that, I'm unable to envision that at scale what they could have achieved. Because for most car companies, they are not exactly super profitable. But when you're able to own the whole supply chain. So, I mean, so the strength of Tesla, as we have seen during this pandemic, is they own the whole supply chain. So there's no supply chain problem. They are able to manufacture really from scratch to finish themselves. And so when you have a business like that, it's going to take an insane amount of investment upfront, and you're going to be unprofitable for super long. But what you have at the end of the day is that you have a very, very resilient business model. And, they really demonstrated their strength in this case, in terms of the car quality, in terms of their production capabilities. The media is always going to write like, they are not able to meet their production numbers, at least in the past. Right now, nobody really talks about that. But, it really shows the strength of that. And, in a sense, when I was looking at it back then, it was very hard to see the profitability and stuff. But I didn't really get what Elon was trying to build. And he's really trying to make the business more anti-fragile in that sense.
I mean, Elon himself also thought it was going to fail. So
yeah. Today he will say, I also didn't expect it to.
But that's really good insights, right? And I think in the same vein of John's question, right, was there a tweet, right, that you write and you put in a lot of effort and you think, I think this is going to blow up. And then how about the reverse, right, where you just didn't really put much, but you're like, the Gary V inside me says, I got to put out something, regardless. Then you just simply put out and then it blows up, right? Do you have any examples of this?
Yeah, definitely, right. So I mean, one example is I did a summary of Jeff Bezos' letter all the way from 1997 until 2020, I believe. I thought that was going to blow up, but in the end, not many. And I mean, there's always the other set of examples also. Like I spent maybe like 5 minutes writing, then boom, 1 million impression. So there's definitely issues like that. And I guess the key is if you are a content creator, you just need to keep hitting the publish button. And the other aspect to it, right, is sometimes when a content don't go out well, it is usually how you present it. Sometimes the content is fine, but when you're writing the hook, so like for your YouTube, it probably is the title, so on and so forth, or your featured image, what words you want to put. For Twitter, it is going to be how you present that information in the first place that gives the reader the feeling like if I don't read, I'm going to miss out a part. My life is not going to be complete. You have to give them the feeling. Yeah. So, I mean, there's definitely going to be a lot of times whereby the content doesn't fly. Then a lot of times you just have to change the way you present that content. Then maybe it will perform better the next time. Yeah.
Right. So then is there one where it surprised you that it even blew up in the first place?
I think those more low effort tweets would usually be like book recommendations. I have no idea why book recommendations always blow up, right? I mean, I guess people really like book recommendations, but usually those take like 10 minutes or so, but it usually...
That's right.
Yeah, so I'm not sure why also. I mean, even until today, some tweets that blow up, very low effort, I'm also not sure why they blow up. But as content creators, we just look at the data and then see what works, what doesn't work, and then we just double down on what works.
Right. Then how about tweet threads that you've made that you would recommend? Like this is a Thomas Chua, thread, right? How do you, if you have any?
I think the Warren Buffett one definitely is one. I actually summarized Warren Buffett letters from his first shareholder letter in Berkshire all the way until the latest shareholder. So, I mean, I think Warren Buffett was one of the one that really gave me a big aha moment. And I felt like a lot of readers can benefit from this, but it is actually tough because each shareholder letter is like 10, 20, 30 pages.
Correct.
Yeah, and it is very wordy. So I try to really take out the key points, because sometimes on a yearly basis he will repeat certain things because he has to assume that there are some shareholders who never read or may have forgotten, because his writing principle is he's going to imagine his sister who know nothing about the investing about stock market, so it's going to be a bit repetitive sometimes. So I really take out the essence of his shareholders letters, and so that my readers is able to grasp the essence and the key takeaways from Warren Buffett within just maybe 10 minutes or so. And so, like, if you were to go to my Twitter page, right, it is the pinned tweet, basically.
Yeah.
Just see right there.
Yeah. I love that tweet, to be honest, and I think there were so many things that, for those who have not read the classic, this is virtually the Bible of value investing, right? It cuts across many aspects that I would say as myths today. Like, for example, people, things like value versus growth, things like, risk, things like, operating leverage and all these kind of things. I think many people assume they know Warren Buffett, but unless you read the classics many times, like Monish Prabhai, I just listened to him, right? He said, right, he has reread the letters how many times? I lost count, to be honest, and yet he still gets new things. So love the tweet. Love the tweet. Yeah.
I think that is a must do for every budding investor. Whether you want to invest the way he does, I think the amount of things he shares is just amazing. And speaking of that, right, was there a standout year for you in terms of like, as you say, there's no repetitive stuff. Was there one year that really stuck to your mind and say, this is one of my favorite? Or it can be years, I guess. It doesn't have to be 1 year only.
The truth is, I don't know which year, which content is from, because for me, right, I combine the whole PDF into one long PDF. And so, I'm always scrolling up, scrolling down, and I make bookmarks based on topics. So not based on years. So there isn't really a year whereby I can recall that really stand out to me. But for new investors thinking about how we should approach a company's marketing spend, or like what you mentioned about operating leverage, or even the nuances of accounting or competitive advantages, then Warren Buffett letters is definitely something you have to check out.
Yeah.
I
like his sarcasm. Actually, the letters I really enjoy is his sarcasm. It's like there was one time about growth and value, and then it says it's something along the lines of cross-dressing or something. I can't remember the exact words, right? Because that one is like, it sticks to you. It's like a slap in your face. Right?
Oh yeah. That's and I guess, like, for you personally, right? Do you have a standout lesson from Buffett? Because there's so many, right? But is there one?
I think one of it definitely has to be the point on See's Candy. So he actually talks about the difference between an asset-light company and an asset-heavy company, right? So, I mean, when you look at See's Candy, the beauty of it is that it's able to grow without requiring a lot of capital. So I think the return on invested capital is like 25% to 35%. So when he do out the math like that, it really just made a lot of sense for us to invest in, companies that have pricing power. And another one I frequently cite, right, is his comment on, this might have been his AGM, because I watched all his AGM as well. But when asked about inflation, right, the truth is not all companies are going to be affected the same. If we were to think about, let's say today you are a very famous doctor, if today the dollars goes to waste, and people have to pay you in terms of seashells, you are still going to be able to collect that payment in whatever currency is required. It could be Bitcoin, it could be this, it could be that. But it is always back to which company has the strongest pricing power. And, they are able to pass on. It could be inflation, it could be, the dollar falling down. people are going to pay them for their product somehow or another. So which is why when people ask me, are you concerned about, crypto coming up? Are you concerned about inflation? I will usually give them this example, whereby, if the company has pricing power, and consumers really want their product, they're going to be able to charge in whatever currency, or they are going to be able to pass on inflation to consumers, and they're going to be fine.
That's a good point, actually. Yeah, I forget that was one of his points about currencies as well. That's a good point. So,
Actually, just to add what he just said, because I have the tweet here. It says, during inflation, goodwill is the gift that keeps giving.
Exactly.
Because it's like there's no change to the value of the service or the product that is being consumed. And I love the way that Thomas actually put the analogy, regardless of what currency, whether it's rubles, whether it's Bitcoin, whether it's as long as that the demand of that product is being consumed and the goodwill has been built over the years, it's just continuously going to compound.
Yeah, man. That's a good reminder as to the situation that we are in right now. So and picking investments. You've been on Twitter for quite a while now, right? And obviously you've come across many opinions. Maybe you've abandoned some of the beliefs you've held, you've added to it, subtracted, whatnot. But I'm going to put you on the spot. I'm going to ask you, what do you think is the most controversial opinion that you think you hold about money in general? It doesn't have to be investing, but it can include investing. But about money. Yeah.
What's the most controversial opinion I hold?
That you'll be quite afraid to put it on Twitter right now. Maybe. If there is one.
Let me think.
Or maybe if you really put it on Twitter, who knows?
And then you got a lot of brickbats for it.
I'm trying to think of I don't think I really have a controversial opinion, but I think one thing that makes most people surprised is when they ask me how much emergency cash I have, I usually tell them 2 years, and they'll be shocked. Like, why do you keep 2 years? I thought the rule of thumb is 6 to 12 months. But, I see value in that, in a sense. You always have to find that number that is suitable for you. In terms of, like throughout crises, you're able to hold through. You have that holding power, because in order to finish, we must first be able to finish the race, right? And same thing with compounding and growing your wealth. I don't want to be in a situation whereby, maybe some of my family members, get into medical emergency, need cash or something, and then the market is doing very badly at the same time. I don't want to be put in a position whereby I liquidate at rock bottom prices, which is why I hold quite a lot of emergency fund. In terms of investable cash, I'm usually fully invested, but the 2 years is strictly, no matter how bad the market fall, I will never invest that amount of money. And I will always make sure that my insurance, so on and so forth, is taken care of. It is always from protecting the downside point of view. I really don't want to be put in a position whereby one day I need to touch my investment just because, I never handle my personal finances correctly. So, there's a lot of investors who tell me like, why you keep so much cash? But it is really from an anti-fragility point of view, right? And from COVID, we can tell, like, a lot of companies that are previously, they were leveraged up to the neck, not because they got bad business model, but, they were trying to buy back shares, so on and so forth. They really leveraged maybe 3 times book value or something. And you really start to see that fragility comes in, and they will have to be at the mercy of the capital markets. Same thing in 2008. So, I try to, when I look for a company, I look for anti-fragility. So when I conduct my own affairs as well, I try to be as anti-fragile as I can.
Oh, very true. Yeah, that is something that will be deemed as extreme, I think. I can agree to that. But, in the same vein, right? Have you seen like an opinion, a thread, whatever, or an account on Twitter where you look at that and then you think, well, some of what they're saying is kind of either challenging my beliefs or at least causing me to, I think the phrase is to, put a stone in my shoe, right? It's like to annoy you a little bit and say, that's not really what I believe, but, I'm starting to see some value there. Is there any such tweet or threads? Do you remember?
So maybe one example whereby I had to unlearn and relearn is about options. I think it happened last year because I always thought options, is speculative instrument, so on and so forth. because Warren Buffett is always saying derivative. It's what
weapons of mass destruction. Right?
Yes, mass destruction, right? Weapons of mass destruction. So I never gave it a thought until I saw some other folks publish content out there on how we could actually make use of volatility by trading options. So the way I use options now is very closely tied to how I invest, because the way options is priced, right, is going to be based on a few things. The interest rate is going to be based on whether the company issue dividends, and most importantly, bulk of the pricing of the options is actually driven by volatility. So when the market is extremely volatile, like in 2020, in March of 2020, right, you're actually able to sell puts on companies you want to buy. So rather than buying the company outright, so for example, I was buying Berkshire or even Facebook, Google, Amazon, so on and so forth, during the pullback, rather than buying the company outright, I can actually sell puts on this company. And when I sell puts, I get a premium upfront, which I can immediately invest into the market. So this is like float, right? Like what Warren Buffett always talk about. There's float generated, and when it hits my exercise price, the premium sort of act as a discount coupon. Rather than paying maybe $200 for Facebook, when I sell a put option, I get $10 in premium. Then in the end, I'm only paying $190. So that was quite a big aha moment for me, because previously, whenever people talk to me about options, I'm like, I don't gamble. I just dismiss them. But when I saw some folks write about how they do it step by step, and then that was just mind blowing, right? Because it is actually, you're just doing it on companies that you have done your fundamental analysis on. You have conviction, you want to own them. And through options, you're able to get the float that come in, and you are also able to, reduce your buying price.
Yeah.
Also, there's actually very, very intelligent and smart way to actually do options, which is actually not speculative at all. So that was the biggest aha moment for me last year.
It's like a magnifier like that, right? Of your hard work, essentially, just adding that additional returns.
Exactly.
Yeah. So now, I think one last question on investing, and after I'll talk a little bit about personal finance. One of the things that is great about Twitter is that you can meet all sorts of people, right? So is there anyone on Twitter today that you really look up to? You've mentioned like some of the mentors or whatnot online, with books, and whether it's your Howard Marks or Nick Sleeps or all that. But I want to know, is there anyone on Twitter, maybe they have not read a book, written a book, but they write really good threads about investing?
I think Honam is one of them. From Alto Ventures, I think Honam is one of the very high quality follows. Then I think if you're interested in the Chinese market, Rui Ma is one of them also.
It's a lady, right?
Yeah, from Tech Bus China. She tweet really good insights into investing in China. Then when we look at the Singapore base, right, I'm actually very grateful for Eugene, because he was actually the one who asked me to go on Twitter. Eugene is I think he comes onto your podcast quite often.
Yes.
Vision Capital, right?
Yes, he's a great guy, right? Super growth oriented, and he really looks out for other people. So I'm actually really, really grateful for Eugene. Actually, he's the one who recommended me to you guys, I think.
Oh, really? Wow.
Yeah, so he said like, FIRL, you must go there and do the interview, because he says like, this is his word. He said that you guys are the best interviewers. So
Gosh.
yeah, so
very kind of him.
So he really has think quite highly of you guys. And so like Eugene is also a great follow on Twitter. He really shares a lot of the earnings breakdown, so on and so forth. Yeah, and the only reason I was on Twitter is because last year I think I met him in September 2020. I remember. Yeah, so that was when I started becoming active on Twitter. And that is really when a lot of the idea flow actually comes from. So yeah, so a big shout out to Eugene. Then I think another guy, I think two other guys, Calvin Sito and also Max Cole.
Okay, I was wondering when is he coming out?
Which is also both on your podcast.
Yeah, that's right.
Yeah, but definitely those are very, very good good follows as well. Always creating a lot of value for the community.
Yeah. I was wondering if you didn't say Max,
I think he will come and probably strangle him.
I will timestamp.
I think right after this, I will receive phone call.
Correct. I will timestamp this particular moment and I'll let Max know, that you didn't mention him. Yeah. Thanks for sharing that. I know Rima and I do follow Honam, so I think it's
Honam is good.
Yeah, I mean, and the thing is, the thing about Twitter, I realized is that there's a lot of garbage out there. Like, it's so much just hype and speculation. So, when we got guys like that available, such as yourself and the people you mentioned, I think it really helps with at least the mental side of things. Definitely. So, actually, this is the last question about investing. My apologies, right? And that is, people like starting out, right? And I know you wrote a lot of articles about what you would tell your 20-year-old selves and things like that. So maybe for someone starting out today, right, what are like the things you would definitely do to tell them to, prepare themselves for this very scary world called investing? And maybe as a supplementary question also, if someone wants to be a content creator like yourself, specifically on Twitter, what are the tips and tricks?
Okay, so I mean, for the investing question, right? I think most should take action, because I mean the best time to invest is always 10 years ago, right? The next best time is now. I think you can start with indexing while learning at the same time, because I think for most folks, right, the friction is quite big, unless you are quite a fanatic like yourself or me, right, whereby you really take action to really read a lot of stuff. But I think most people, the highest ROI would just comes from starting to index, get it going, get it momentum going. And then if you are interested in investing in the stock market, I usually recommend Peter Lynch's book for beginners, because he writes in a very entertaining way. Definitely not the Ben Graham book, right? Because I think that would make most people quit investing if that is the first book. First book they read. Oh yes. This is one of the tweets where I get a lot of shit from Twitter when I say like nobody should introduce to a beginner Benjamin Graham book, because nobody will complete that book. It is so technical and it is not for this era. Yeah, so I mean, once you get the momentum going, then I think it's better to read other books. But I think Peter Lynch writings is a good place to start. Warren Buffett, a good place to start. Then maybe Gautam Bate, The Joys of Compounding, is also a good place to start. Yeah, so I mean, I guess the right place to start is really through reading, and then do your analysis, write down your thoughts. I mean, it is definitely, you're definitely going to feel insecure about investing at first, but I think it is always good to dip your toes, start small and then slowly trudge in, build up your confidence. Because there are certain things that cannot be taught, right? I mean, one is your experience, and two is you cannot teach volatility, right? Sitting through volatility, and you really have to experience it in order to feel how it is like when you see your portfolio shrink by 50% and then go back up maybe 100-200%. You have to experience that emotional cycle. Yeah, so just start as soon as possible. Then on the content creation question, I think is you have to publish regularly, because I think for most people you need that feedback loop.
Yes,
content creation is all about feedback loop. You have to try. Everybody will have different writing style. So I mean, some content creators I see, when they try and adopt my writing style, it doesn't really fly well for them, because I think you have to build up that so-called branding with your audience as well. So it is about, I think, publishing consistently. I mean, if it's going to be Twitter specific, I think if you have smaller than 5K followers, at the start, you probably want to spend like 70% of your time engaging big accounts, 30% of the time is writing your tweets. And then once you cross that threshold of 5,000 followers, right, then I think that's where you can really put 80-90% of your time writing your own content, because by then you have your own following already. Otherwise, at the start, you're just tweeting into the air. Like nobody will read your stuff. Yeah. Then after that is, don't be too harsh on yourself. I guess the imposter syndrome is very real for most, which is why a lot don't publish regularly. Just go ahead and publish regularly. Yeah. And once you get a feedback loop in, you have to get a feel for how the algo is like, what the audience likes. And then, then I guess usually with consistent effort, your follower count will just build up.
I think that's very simple, but quite executable advice, right, John?
Yeah. I mean, I'm just looking at the amount of tweets, right? He has 5,526 tweets. So if you want to talk about discipline and consistency, this is where you look at, man. Join October 2020, 29,000 followers. Hats off. Yeah, hats off,
Yeah, man. Okay, now this is the last bit that I really want to learn about yourself, and that has to do with a bit more personal finance, right? So I think there are on my side 3 questions. I'll just ask the first. I think slightly less so in Malaysia, but still very relevant alongside Singapore as well. Definitely very relevant in Singapore. It's actually quitting your 9 to 5. And I know it's something that you've written articles about as well, about the fears and like how do you prepare yourself. I think you did talk a little bit about how you have 2 years of emergency funds.
Yeah.
So I'm sure it's tied into this question, and that is, what do you think are the conditions for you, or maybe share your story on quitting 9 to 5, and what would you say are the right conditions for someone to quit, and how do they manage the world of a no 9 to 5?
I think first is the idea of quitting 9 to 5, right, is not to chill at home and do nothing. So, I mean, creating content is like a full-time job, like you guys like that. I take it very, very seriously. But the idea here is that, there's always the phase in life whereby you are exchanging time for money, right? Maybe you are doing work that you don't really enjoy, you are trying to build your capital. But I guess for most people, or a few of my friends, they don't really know when to, do that pivot from that accumulation phase and doing work that they hate to that phase whereby, they're doing work that they like on a more sustainable basis, which is why you see a lot of people looking forward to traveling, holidays, or, they're chasing after FIRE, right? The financial independence, retire early.
Yeah.
When I hear people chasing after FIRE, it's just a very strong indication that they're doing something they hate. Yep. Or, people looking towards the next holiday every single time. I mean, granted that, you get to go on an adventure, you get to experience other things, but it is usually because you hate your life here. And so for myself, I was actually lucky enough to ride the COVID V-shaped recovery up. And back then, so when I was employed, my emergency fund is around 6 months. It is not as aggressive as now. I mean, now it's because, like you said, I quit my 9 to 5. I'm doing what I like, which is investing full time, and writing about my thoughts online. Yeah, so which is why my emergency fund becomes way more aggressive. But I think for everyone out there who's thinking of maybe pivoting, maybe it's the right time for you to pivot already. You always want to make sure that your downside is taken care of first. Because I think it is very difficult to start a business and do it well if you always have your back against the wall. Like, your bills, all this must be paid, so on and so forth. It's going to make you make decisions that are not the most ideal. And so I like to make sure that, if today I don't work, the next few years I'm actually covered. So like if I were to liquidate my portfolio, like I can survive for many, many, many years without worrying. That might be a bit aggressive for some, but I think most people don't have to be as conservative as me. But what is more important is while you're still employed, while you're still having a paycheck, it's important to test out your idea first. So for myself, I started writing 1 year before I quit my job. Because when I take the scholarship, it actually came with a 4 years bond with the Singapore government. So, at the 3 year mark, I was very sure that, I was going to quit, which is why I started meeting a lot of people, trying out different things at the side, and eventually I found writing to be the one for me. And, it is really when, the financial aspect is taken care of, and two, there's a demand for my writing, then that's where it's a good time to pivot. Because ultimately, for most people, I think the bill, the family, the dependence is very real. Just like, I still need to make sure my parents are taken care of, so on and so forth. So always make sure that these basic needs, these core needs are taken care of first. Once it is settled, then I think it is a good time to start making a pivot. And the example I'd like to give here is, the Jeff Bezos regret minimization framework. And I actually sent this to all my colleagues on the last day of my employment. which is basically like every one of us, I believe, have something we really want to do, but because we Asians usually delayed gratification, right? We put off aside and then we try and build, we try and save, so on and so forth. So for Jeff Bezos back then, he was making, I think, in excess of $100,000 back in 1990, so which is a lot of money, right? And when he wanted to start the online bookstore, his boss actually tell him it's ridiculous. It is a good idea for someone else, but for you, you have a bright future. Why you want to do it? So he always try and imagine himself at 85 years old. Would he regret not doing this or not? And if the answer is yes, he probably would make the move. And I find this to be a very good framework when it comes to approaching difficult decisions in life. So, I mean, for myself, if one day I regret what I've done, I can always go back to the workforce again. But I think for a lot of people, they think that the risk is very high. It will be, it is a non-reversible decision. But most of the case, it is going to be a reversible decision when it comes to pivoting to, doing something you truly love. And for me, that's just investing and writing. And I think the bigger risk here is, at the end of the day, we wake up 50, 60 years old, and we live our life, just being afraid. And then we never get to do certain things, and, our youth, our time is over just like that, and we just keep doing the job we hate, so on and so forth. Yeah, but granted, there are going to be people who love their job, like Max, right? Max, he loves public speaking, so on and so forth. So he really likes what he do. But for me, I was growing up. I had a more defensive stance because of my family's money situation. So I didn't get to have the opportunity to really venture into doing things I like. Everything was making sure the bills are paid. And build a basic capital first. And it's really trying to get that privilege to do what I love going in the future. Yeah, so once I built up that basic foundation, then very quickly I started to want to, really test out whether there's demand. And if there's demand, my finances are secure, financially secure, then I just went for the pivot out of my very, very stable government job.
Actually, I love what you just said about the reversible or the pivot, because like what you said, a lot of people think in linear terms and you go in this direction, you can't turn, right? What do you think stops people from doing that? What is it, a mental barrier? Is it influences of opinions of people around them? What do you think is the strongest factor pulling them back? Because what you went through was exactly what I went through, to be honest. So yeah.
So the biggest reason whenever I do this, and ever since I did that, I wrote that article, it was viewed by many people, and many people approached me regarding this. And the biggest number one reason I always hear, right, is that finances. They're worried about finances. But if we were to go 5 level deep, right, of why, it's usually they're afraid of failing. It is not because of money. To be honest, I think most people are quite financially secure. They are in their 30s or even, maybe early 40s. A lot of them I know have a very sizable bank account already. But they don't dare to do the pivot. And they say it's always like, oh, I need to give up my salary, so on and so forth. But I mean, maybe for context, some of them have more than $1 million already, but they are still, they're still permanently worried. And I really think like it is, you are not worried about money. You are worried that you will be seen as a failure when you try and you fail.
That's a great point.
I mean, to me, right, if I don't try, I don't fail, I will never find out. And that would be a much bigger regret. And I think in life, if we always think about what other people would think of us, but the truth is most people don't spend their day like, hey, what is Thomas doing? Is he failing? Is he succeeding? Nobody give a shit.
Yeah.
Most people are busy thinking about themselves. But yeah, I mean, I really think that's the biggest holdback for most people. And it is such a waste of human potential, right? Because a lot of people I speak to or I see a lot of potential, but because they are unable to disrupt themselves, just like Kodak cannot disrupt, or Nokia, cannot make the pivot from buttons to touchscreen. And, they just live their life all the way until they're old. And, then they will tell me, I mean, I speak to a few folks who are above 50 or 60 in my company the previous time. They always tell me if I could reverse time, I would definitely take the pivot, and you hear that very often. But when you speak to the 30, 40s, they will say like, oh, cannot, money, this or that. But I mean, the truth is, it is just a lot of fear of failing, fear of disappointing other people, fear of what other people think of you. Yeah. So I think fear of expectations is really the biggest culprit here.
I love that you said that because people actually call me up after I left my previous company. John, how do you get the courage to do it? I don't know. I just tried. I don't know whether I'll succeed. I'll just try, And it's so good that that you brought it up because a lot of times people mask their fear in thinking that they are actually financially not well off. But at the same time, I think the reason why they have that fear as well, Thomas, is that they haven't sat down and really think hard about it or really put it down on paper, make it clarity. That's my 2 cents, to be honest. Because how much, actually, if you ask a lot of people, I don't know whether your sampling is the same as mine, but if I ask a lot of people, how much do you actually need to survive? It actually stumps them,
Yeah.
I don't know about you. It actually stumps them because they say, you've never thought about how much you need, that kind of thing. Yeah.
So there's a very good exercise by Tim Ferriss, right, which I actually did when I thought of leaving my job, which is called the fear setting exercise. Mainly, you write down a list of your fears, and then you write down what are the possible solutions you could do to mitigate all these concerns. And usually, it all boils down to just your fear of failure. All the money, everything could be fixed. It can be fixed one. Yeah. It is really just ourselves that, that's holding us back.
Great.
That's fantastic. I mean, for context, right? What government job were you doing?
Yeah, so back then I was in IRAS, basically the Inland Revenue Authority of Singapore. And I was dealing with taxes. Yeah, because I signed their scholarship. So, when they sponsor for the university and the overseas education, which I'm extremely grateful for because I think that was the one point in my life whereby I didn't have to worry about money because there is money coming in. I didn't have to worry about bills. They pay for hostel, they pay for my laptop. They really pay for everything. So I'm very grateful to have that scholarship pay for everything. But at the same time, if I'm being honest, right, when I signed that contract, I already knew like that job wasn't for me. It is solely for that security. And so very grateful that it helped me build up the foundation to really get the privilege to where I am today. But basically that's about it. And that is also where I learned from a lot of my colleagues, especially the older ones, like what their regrets are. And then, that gave me the courage, or it helps me with my decision making as to, what I should be doing because, there's a very clear example out there. And if I were to reverse that to where I am today, the decision making becomes quite obvious.
So we should talk to old people more. That is my conclusion.
Always go.
Always go. Now, I'll move on to the next question that I have, which is another one of your articles, which is not something, people talk a lot about. And that is, the amount of money you should be giving your parents.
Right.
And this is really maybe for, Asian people only. So any of you all non-Asians, it doesn't mean that you don't give money to your parents, but I guess the pressure is not as big, right? So there are many ways, right? Like some there's this Singaporean podcast, I think it's called The Daily Catch Up. And they also had one whole podcast about how much they should be giving their parents, right? And so this in one of the cases, the mother was this aggressive person where they says basically they need to see how much you're earning, and then they'll essentially tax. Essentially, it's your former job, right? It's taxation, essentially. So that's like one method. And then there are other parents who are like, just give me whatever, things like that. And then you've got parents who are who really need the money from the children. So what would you say is your method of determining in your case, and do you have advice to give other people?
Yeah, so that is I mean I wrote about that because and that became the most viral article on Seedly. I mean I first published that on Seedly. Yeah, okay. So that one brought in I think maybe 35,000 views. And just for context, right? The second most viewed article is I think about 5,000 views. So
7 times.
So that laps like I think the next 10 articles weren't as viral as that article for opinion writers. Yeah, so I guess it became viral because a lot of people found it super relatable, right? Especially in the Asian context. I wrote that because I had a lot of friends who were living quite difficult life because their parents keep comparing amongst each other, like how much is your kid giving? Wow. And they wear it like a badge of honor. Like if your kid is giving me 2K, or so on and so forth. They just like to compare. And when I see it, right, usually when the parents is taking a large amount of money, it is not because the parents need that money. It is really from an ego standpoint, from trying to compare with other parents.
Wow, bragging rights, in a way.
Yeah, bragging rights. They're just trying to say, my son is, giving me this amount, like, and they infer to the amount given as how much the son loves them. Which is really toxic, right? Which is really toxic. And the truth is, most of my friends, when they first come out to work, maybe they make like $4,000 or $5,000 a month, and they need to give like $2,000-3,000 to their parents.
Gosh,
it is not sustainable. I mean, and you're talking about the time whereby you're trying to build your home, start a family, so on and so forth. It is incredibly draining to do so. I mean, of course, on the other aspect, right, there are kids who don't give their parents anything. And I think the point here really is you have to talk about it with your parents. And as parents, you need to be honest with yourself as to, do you really need this amount, or are you just trying to win the, compare with the Jonases? And if you are doing that, I think at the end of the day, we must always go back to understand what we are trying to go after, right? And it is really family harmony, because when your family is harmonious, it is really, really priceless. But when we like things like this get in the way, when it comes to comparing with the Jonases, then I think you're just bringing unrequired stress into the family. And at the end of the day, you realize that, when your kid or your parent, they're healthy, you have good relationship, that's really all you need. I think for the parents' allowance part, it is going to be very, very, very specific to each family, depending on how much nest egg the family have, right? So, for example, both my parents have no savings, zero. And so, like, the way I approach this is going to be very different from how my friends approach it, because I mean, me and my sister, we have to be the one to pay the bills and everything. Yeah. So, for most people, I think just directly have a very, very clear conversation with your parents. And then you have to lay out, like, what are you hoping to achieve in the future? Like, you have to lay it out to them and let them know and understand that you're trying to save for your own retirement, and at the same time you're going to start a family. And it is definitely not easy being in the sandwich generation, right? I mean, when we look at our parents, the reason why they have that mindset is because the family nucleus is big. Like, when I look at my mom, she's 1 out of 10. 10 people support 2 parents is definitely different from 2 people support 2 parents.
100%.
I mean, and last time things are not that expensive. I mean, when we look at Singapore housing prices during my parents' generation, they bought a house for like $25,000. When I look at the housing prices today, it's $300,000-400,000. It is a very, very different landscape. And so you need to help your parents understand that, and work out a figure that's enough for them to live respectably, so on and so forth. But when it comes to this, I think comparison, or rather envy, is the biggest evil of all.
That is actually a very interesting insight. I didn't know, like, it was such a competition. But I mean, without sounding too stereotypical, that is Singapore for you, right?
Everything must compete.
I mean, a follow-up to that would be, I think, something maybe more on the touchy-feely side. And, feel free to not share if you feel that you don't want to answer the question. But how, I guess people want to know, like, how do you prepare yourself for that conversation, I guess, with your parents, right? And then in your case especially, right? Because they have no savings, right? It's very different for someone who perhaps parents are pretty decently well off, and it's more about giving back as a token sum rather. But in your case, it's a matter of necessity. So how did the conversation went actually?
So, I mean, if I'm being very honest here, right, I don't have a very very, very smooth answer to this, because for my family, our communication style is we fight. You will fight, because I mean, I will disagree with how he manages money. My father manages money. He's going to disagree with how I manage my money. I mean, I strongly believe I'm right. He will strongly believe he's right. Yeah, and so we will fight. But I mean, I would say that this is, I wouldn't say it's unique to my family, but I guess in life we have to play our cards, whatever cards we are dealt with.
That's right.
And so for me, it is difficult for me to take the spreadsheet out and then explain to him, these are the factors. No, he's not going to listen. He's not going to listen. You have to speak in that language, and I will speak in Hokkien when I'm communicating, right? Yeah. So it may not be what a lot of people what is applicable to most family out there. Yeah, but for me, our communication language is Hokkien, and then it's going to be quite argumentative, But I would say for most of my friends out there, I would just tell them, just explain to your family nicely, because most of them, their parents are working adults. And so when you have parents who are working adults, they generally are able to understand these concepts a bit better, because whereas for my family, not much working experience, mainly just that I think it's quite different from what other families. I think for most parents, you are able to talk some sense. Okay, maybe that's the wrong word to use. You're able to reason with them, show them like your expenses and this and that, talk to them about investing, they will understand. But for mine, I think it's a bit unique in that sense.
Thanks for sharing.
First of all, thanks for sharing, man. Being transparent about it. Thanks.
I think these are some of the more hidden. I think like personal finance is, when I read blogs, it's so much of it is about the math, right? But basic things like how do you even start the conversation is not really in the conversation online, at least to me, lah. Okay, John, any more questions about personal finance and all that?
No, I think I'm very heartened that Thomas brings a very unique and personal perspective, because a lot of people think that investing is only for I think it's quite sad that investing usually is for people who are a little bit more well-to-do, because they've already gotten their basics settled. And I think this for me, if I were to allowed to express myself, is that he brings a perspective where now, because I have managed to settle myself, then you can actually help out with the parents, even though it may be a little bit more confrontational and all that. And hopefully this gives hope to those who are in similar situations, that they may be able to do the same.
Actually, to your point, John, maybe I'll ask Thomas as well. What about the reverse, right? Let's say you get someone who doesn't want to give a single cent. Will you start speaking Hokkien to him?
I mean, if I were to look at, I definitely have friends who don't give a single cent. I think we always have to look at context, right? In America, that might be normal, but in Singapore, or rather Asia, right? Asia in general, I think when we talk about context, I think children still have to give parents a bit. Unless the parents just outrightly say, I don't need anything, just save it for us. I do see a few family like this. But I think it is still important in our context for children to actually give parents, at least a token sum, or at least help them defray some expenses. Just because, we always must put everything in context, right? And growing up in this region, you are going to tear your parents apart, if they have the expectations that they will get something. But in the end, they are just going to infer as, you don't love me. I have an unfilial kid, so on and so forth. Yeah. So in that context, I think have to give something, and the amount to give should always be communicated directly with your parents, and try and get understanding from both sides and work out a figure that's able to keep the family relationship intact.
Yeah. Great advice.
Right. Yeah. Actually, that's probably maybe another article for you, right? What if you don't want to give your parents any money? Then you just film a video of you like slapping a door, maybe. So this last bit really has to do with outside of investing, right? Because we've got like Eugene on, and I know Eugene is someone who has like a very active life. If you follow him on Instagram, the only reason why I don't call him Buddha is because he hasn't shaved his head yet, But what do you actually do, I guess, for fun? Because we always want to understand a lot of our guests, like beyond just what they do in their profession. Do you do something for fun, or like investing is the only thing you do?
Yeah, so maybe I start with what I don't do. I don't drink alcohol. I don't gamble. So the reason why I don't even gamble on Chinese New Year. I have no idea how to play all the poker cards, so on and so forth. And Like when I used to play basketball. So if you ask my teammates, whenever we go overseas, like to Macau, to Hong Kong, Australia, so on and so forth, they will always go drinking, and I would be the only one not drinking.
Making free throws.
Last time when I was younger, I say that I'm allergic to alcohol, but now that I'm older and I'm not really there's no more peer pressure. The reason is because when I look at my own family members, right, I try to be the opposite of what they are. So I try to live a very disciplined lifestyle, and I guess the best way to quit an addiction is not start one. So I don't have TikTok. So on and so forth. Yeah, anything that people say is addictive, I just don't do it. I don't partake in it at all because
Do you still
I'm
play
very
sports?
Yeah, so I still play basketball from time to time, but nowadays because of my knee operation, I'm less intense. But I go to the gym every day. Either I go to the gym every day or I'll go run every day. So my routine is actually quite similar to Eugene. I also start my day around 5:30 in the morning. Not because I set my alarm or what. I think it's just because last time I had to work, study, and CCA, extracurricular activities to build up my resume. So I always go to sleep at like 12, then wake up at 4:30 to do my work, and then I'll go to gym. So that habit sort of trickled even until today, and so like my body clock is still that way. I'm trying to change it because I read a book by Matthew Walker, Why We
Better
Sleep.
sleep.
Right?
Yeah,
it's important for long-term health. So I've been trying to push back my sleeping time, but not much success. I still cannot stay. I still can't stay asleep. I'm very awake at 5:30. Wow. Yeah, so my routine is right off. When I'm awake, I will do all the heavy analysis work. The previous night, I'll prepare a list of things for me to read. Usually, I put the most difficult things first off in the morning, because right in the morning, right, our brain is primed for analytical work. So if there's a very difficult company to analyze, or if there's certain white papers that's very difficult to understand, I'll put first 2 to 3 hours. Then after that, I'll proceed to writing. Then I will break up the tempo by going to the gym. Then the afternoon is where we are primed for creative work. So like if I need to redesign my blog, the UX, or I need to edit my words to make the Twitter content flow better, that's where I do it. And then the late afternoon, which is around this timing, is where I schedule, like if I have interviews, I'll schedule during this timing. Or if I'm networking with other people, I try to put it at this timing also, because I am not very productive in terms of doing analytical work in the late afternoon, so on and so forth. Yeah.
Right.
Why do people need to go to NS when they can live a schedule like you? I'm just kidding. I'm just kidding.
You say you play basketball, right? Are you following the NBA?
Last time I used to follow very closely. Now less so. I mean, I used to play basketball every single day, right? For my university, for clubs, for this, for that. Like my schedule Monday to Sunday, it is every day we'll have basketball training. Wow. I mean, if I was telling my other teammate, if I ask my younger self, do you know that one day you will not be playing basketball every single day? I'll be quite shocked. What are you talking about? This is going to be my life. Yeah, but the fact is now I play about once a week or something like that. Yeah.
Right. Yeah. Was that like? Do you have a team that you support?
I mean, no, not really. I never really supported a specific team before. I used to just watch and enjoy the game. I don't have that labeling of like which team I really love. And I think the same applies for investing. I try not to label myself too much, because then you will become very defensive. Your mind will close off to other ideas. So I mean, I always try to prevent putting on a label on myself.
All right. Any players that you
Players-wise,
you wish you could become, I guess, when you're playing?
Oh, I mean, it is not possible to replicate him, but I would think I used to like Shaquille O'Neal a lot, because I play a center, right? I mean, but
you're a center? Sorry, you play center as well?
Yeah, I play center. Okay, so like you probably can't see, but I am about 2 meters tall. Yeah.
So no wonder.
I mean, in Asia, I will play
6'2" lah. 6'2", 6'3".
No. I think it's more.
6'4".
It's more.
6'4". Oh yeah.
6'4".
Yeah.
So I mean, in Asia context, I'm usually the tallest. But when I played China in the past, I wasn't the tallest. I think the shortest on their team is like 183 or something. And everybody else is like almost 2 meters tall. Yeah. So So I mean, at least in Singapore context, I have to play center. And so last time I used to like watching Shaquille O'Neal play a lot because he was just so dominating, right? Like than the only thing that could stop him is a free throw line. And then other than that, he's just unstoppable.
That's true. And I think Yao Ming fared pretty well against him.
Oh yes, Yao Ming did very, very well, but unfortunately his career had to end early because of the ankle, I think. Yeah.
All right, man. Hey, Thomas, thank you so much for being on the podcast. I really enjoyed this. And, for those who want to find you, you're quite easy to find, but just can you let us know where can people find you?
Yeah, if you want to follow me on my blog, that would be steadycompounding.com. And then if you want to find me on Twitter or even Instagram, right, my handle is steadycompound, @steadycompound.
All right, you guys heard it. And definitely give him a follow, especially on Twitter.
Yep.
And, if you stayed all the way until here, it means that you like the content, which means definitely do share this podcast with friends and family members. And go watch some of other stuff on other podcasts on Spotify, on YouTube. And guys, we'll be signing off. And thank you so much for being on the podcast, Thomas.
Thanks for having me, guys.